Hello and welcome to This Is Not Just Ross and Chris, and we are still talking about Scottish property. The reason that it's not just Ross and Chris today is because we have the one and only Kessar Salimi from Freedom Financial Services, or hopefully I've got that right. And basically Kessar is a mortgage broker, a very experienced mortgage broker based in Dundee, but you deal with properties and help property investors all over the country, I'm sure. Kessar, do you want to say a bit more about what you do?
Yeah, hi everyone. First of all, thanks Chris and Ross for having me on today. Delighted to be the first guest on your show. So yeah, my name is Kessar Salimi. I'm a mortgage broker and property investor. I specialize in helping property investors grow their portfolios. Over 90% of the mortgages that we do are for property investors doing their sort of typically buy-to-lets, bridging finance, commercial finance, and then the rest, that's 10%, the residential mortgage that we do generally is for our property investor clients as well. So we really kind of niched into that market. One of the reasons was because I'm investing property myself, so I know that market well. But also the mortgage market itself is so huge, it's difficult to be an expert in the whole market. So I just really wanted to kind of hone my skills into helping property investors.
That's so true. To be honest, I'd never even considered the idea that you would also help people buy homes, home buyers. So sorry about that. But yeah, I mean, you've really, dominated that niche as far as I can see. There are obviously other people out there doing what you do, but yeah, you're very focused on the buy-to-let market, which obviously we are, and that's why we're talking to you just now. Yeah, thanks very much. And being as you are so focused on that part of property, Kessar, buy-to-let lending has been a subject talked about in the media quite a lot over the last little while, and in fact, all lending has. What has been the trend probably over the last 3 months, would you say, or certainly since Liz Truss mini budget?
Yeah, so interesting times after the mini budget. For myself, never experienced this before, for all the lenders to remove their products in such quick succession. And basically that was because their cost of borrowing increased significantly, so they just couldn't price their products and therefore had to remove them. Luckily now the dust has settled from that a little bit. We're now back to normal lending levels. The lenders are lending at full capacity again. There's all the lenders are lending now. There was some lenders that just didn't lend for a long time. But basically, we've seen the cost of borrowing reduce now over time. It did initially increase after the mini budget, but then it was quite slow for the lenders to then reduce the costs after that. I think for a mixture of reasons. One, they were worried that the cost might increase again. And two, they could ultimately sort of capitalize from the situation as well, where there was reduced amount of lenders that were available, and the ones that were still in the market were able to charge much higher rates. But the good thing that we see now is that because all the lenders are back lending as normal, and also the property market has quieted down a little bit, so we've seen a drop in applications as well, that the lenders have started to become more competitive again. So it is better news for investors, and we're continually seeing rates dropping at the moment.
Well, there's a lot to unpack there, actually. Good answer. Ross,
and I suppose, yeah, well, I suppose people would be keen to understand what kind of trends are you predicting moving into the new year, and where could rates potentially get to if they do continue to drop down? Obviously, we're not going back to what we had at the start of this year, but what are you predicting for next year?
Yeah, it's a great question. And we've already seen rates increase previous to this mini budget. So we knew this was going to happen anyway, but it almost kind of supercharged it. But I think in the short term, we'll see rates reduce slightly more, but I can see them starting to bottom out. We might already be there, or we're quite close to kind of them getting to where I think they'll get to their lowest. After that, I think they will then continue to increase again as well. It's still quite likely that the government's going to increase the base rate again going into next year. They're now forecasting between sort of 4.5% as the base rate. Potentially, they were previously forecasting up to 6%, but we're currently at 3% at the moment. So there's still some movement there that they can kind of go up to. Inflation's still quite high. That's not come down, and they're obviously using the base rate as a tool to bring inflation down. There's a few things kind of unpack in regards to kind of rates as well. So the fixed rate mortgages are having to factor in what interest rates will be like over the next period of time. That may be like 2, 3, 5, or even 7 or 10 years. One of the reasons why the interest rates for fixed rate mortgages have been so high is because the volatility in the market. With the base rate going up, it's kind of going up as expected. So that's actually bringing some of the fixed rates down, because they're now seeing that actually the rate is going to be at where we expect it to be. And now the Bank of England saying that the forecast is 4.5%. They're kind of almost sort of factoring that into their pricing. So we might see some of the fixed rates drop down. Tracker rate products have become more popular as well, because they're just factoring the cost of borrowing at today's date. They don't need to factor in future rates, because if the base rate goes up, then the tracker rates follow suit as well. So they've also become more popular. But I suppose to answer your question, I think they might reduce slightly further in the short term, but I think kind of going into next year, they probably will continue to rise.
Okay. And how does government policy impact lending rates? So obviously how housing and property had devolved in Scotland, so therefore would mortgage products generally be different depending on what the Scottish government do towards buy-to-let as opposed to maybe down south?
We've not seen a difference yet, to be honest. There is a chance in the future that there might be some effects from that, but at the moment, there's not really much of a difference. There is one lender just now, Paragon, who have reduced their loan to value on Scottish properties compared to England. There's a 5% difference there now, and they're worried about some of the rules that the Scottish government's brought out, an eviction ban, the rent freeze. Other lenders are also looking at this as well. They've kind of mentioned that if the rent freeze is extended into next year, then they might review their policies. But as far as the Scottish government's concerned, we've not seen anything implemented that's affected mortgage products compared to England.
Okay, yeah, well, we'll see what happens with that going forward. That just affects the amount that you can borrow, loan to value. So what I sort of think, and what I see is that lenders are still happy to lend. In fact, possibly for the reasons that you've said before, that there are a little bit less activity in the market, that they're becoming more keen to lend. More products are coming out, and there was some increase in the stress testing, and we can maybe touch on that in a second as well. But sort of broad stroke stuff, it just feels to me that property investors, can stay active, continue to invest. Lending is still available, which is the main thing. And but what needs to happen is they need to probably just put more money in. They're having to find a bit more cash to put down that deposit and get the mortgage. Partly because, again, 70% loan to value is maybe where a lot of companies might get to, a lot of lenders might get to, but equally for the stress testing, for the interest rates to make it work, for the gross yield, for the yields to be just right, they may be not able to, maybe have to put in 40% or something like that of the value. So and there's still many people out there with cash in the bank that isn't doing that much for them there, and with inflation where it is and will stay where it is for a while, the cash that's in the bank is becoming less valuable, I guess, over time. I'm not an economist, obviously, and don't quote me on any of this kind of stuff. It is just my own personal thoughts that property still works. You can still get lending. You just need to find a bit more cash probably to put into it. Would that be fair to say, Kessar, or am I talking rubbish?
It depends on the circumstances ultimately. So you're right, the lenders do want to lend. Ultimately, they're in this business to make money. There was some negative media storylines, of lenders removing products. And I think because of that, some property investors are maybe cautious just now and think that lenders don't want to lend, but that's definitely not the case. Especially now as the dust has settled from what happened previously, 75% is still typically the norm, loan to value. There's still some 80% products available. You're right, some lenders are down to 70%, but that's just a few, the majority are still at 75%. What has changed things, as you kind of mentioned, is the stress tests. And even that's changed over the last couple of months. So when the interest rates went really high, the lenders obviously had to change their stress test, because previously they were stress testing mortgages at between 5 and 5.5%. And a lot of the rates were now way above that. So obviously the previous stress test just didn't work. And from then, previously pretty much all the lenders just followed that same stress test. And then after that, then the lenders were all kind of basically making up their own stress test, what they thought was suitable. Some were kind of stress testing properties at 8-9%. Others were doing stress testing at the pay rate. Things have settled now because the rates have come down slightly. Some lenders realized that the stress tests were maybe too strict and just weren't able to do enough lending because of that. And they've also eased some of their stress tests. But the main issue we was having problems was with low yielding, high value properties, in particular if they were in your personal name. So we're now seeing a lot of investors favoring higher yielding properties. One, because of the stress test. Two, because the interest rates are higher as well. So the lower yielding properties aren't as viable as they once were. So there's definitely been a more of a trend towards higher yielding properties.
Yeah, I've seen that too.
Yeah, and am I right in saying that the mortgage valuation would be conducted on the market yield as opposed to the current yield, the current rent? So the market rent as opposed to the current rent.
Yeah, that's an interesting question as well. It depends on the lender. Typically, if you're buying a property, it'll be done on the market rent. If it's a remortgage, it depends on the lender. They might go with what your current rent is. And if you've not increased your rent over time, and we're now obviously in a rent freeze as well, that could cause you issues. But other lenders will still do it on the market rent. So it really depends on the circumstances. But yeah, so for some clients where they've not increased the rent over time, it's caused us some issues when we're looking to refinance properties. We're not being able to take out the full loan that we've wanted because they've been charging lower than the market rent.
Okay, anything that you could say on lending around portfolios? So somebody's looking to buy 6 or more properties in one go. Heard some stuff about bridging as being quite a good way to go at the moment. That maybe the interest rates haven't changed all that much in bridging finance, but again, I'm not an expert. What's happening there?
Yeah, that's an interesting point. So you're right. Bridging finance is typically more expensive than buy-to-let mortgages, but hasn't changed that much over the last 6 months. It's slightly more expensive than it was previously, but not by that much. And typically for us, when we've got a client on bridging finance, which is just short-term finance, we want to get them off that as soon as possible to get them onto a buy-to-let mortgage. But some of the rates that some of the clients are on just now is kind of comparable to what a buy-to-let mortgage would be. So it's not that beneficial for them to go onto a buy-to-let mortgage. But the main benefits of going on bridging finance is one, for speed, especially with portfolio purchases. And I know you guys obviously deal with a lot of those. It takes quite a lot of time for buy-to-let mortgages to be put in place for a portfolio. With bridging finance, a lot of the lenders will do desktop valuations. They're more comfortable with the risks that are involved. So, transactions can complete much quicker. From a client's point of view, obviously the benefit of the speed. Typically, one of the reasons why people want to use bridging finance is to bring properties up to a standard that they expect. So it might be like properties that have an EPC of below E, so they can't actually get a buy-to-let mortgage on, or they might be wanting to add value to these properties as well. So that's one of the other reasons why they want to use bridging finance. But you can get buy-to-let mortgages initially, we have done in the past for clients. It really depends on the lender, sometimes on the client's experience as well. Some lenders will be a little bit cautious on a client wanting to buy 6 properties in one go when they don't have any property experience. But then there's other lenders that are absolutely fine with that. Yeah,
absolutely. Okay. Yeah, no, the portfolios, there's, we've got lots of interest in the portfolios that we have for sale, and we have, portfolio sales completing over the next couple of weeks just before Christmas, and they're all going fine. Absolutely no problem with people buying them and completing on the sales. So, which is good for our clients for sure.
Good.
Is there anything else we need to touch on, guys?
Yeah, I just want to I just want to ask a question. We've recently received some data from the landlord registration, which highlighted a drop in the number of landlords registered at the moment. I think there was a drop between January 2017 to December 2021 of about 23,000 landlords had dropped off the register. And I just wondered what level of your business is dealing with first-time landlords, so landlords coming to you for the first time, looking to get into buy-to-let, because we need these landlords to come in when there is so many landlords that are thinking of leaving the sector, because we need that accommodation, because there is a housing crisis. We need that accommodation to be provided for the tenants to keep the rents at a level which is affordable, because less properties out there means rents go up. So just looking sort of some insight over first-time landlords coming to you, what level are they coming to you at the moment? Is it down on what you normally expect, or about the same, or more, or just to get your feedback on that?
Yeah, it's a great question, Ross. I suppose probably my figures will be slightly skewed as well, because the majority of my clients that come to me when they're starting out. So most of my clients will be kind of first-time landlords, or people with quite small portfolios to start off with, and then I help them then grow their portfolios. The good news is there's still a lot of people wanting to get into this business, as much as there is people that want to exit it. There's definitely kind of landlords with less experience that are keen to just get started, and they just accept kind of the new regulations that are involved as just part of business ultimately. And as you rightly mentioned as well, the tenant demand is definitely still there, and it's gone through the roof because of the shortage of rental properties. And for a lot of the landlords that are coming to me, that's one of the kind of key benefits of renting just now, or investing just now even, is that there is a shortage, and they know that they can rent these properties out quite quickly. So for me, I've not seen a drop. So the property market has slowed down. There's not as many purchases going through just now, but we're still very busy with new inquiries, with landlords actually still looking to invest. As much as there's there's a lot of kind of doom and gloom in the headlines just now about the next couple of years, there's still a lot of people there with cash in the bank that don't know what to do with it, and they're worried about inflation as well. And property is one of those things that they're looking at, to help mitigate sort of the inflation problem just now.
Yeah. Well, thank you very much, Kessar.
Always, yeah, thanks for having me.
That's it. Yeah, and that is good. Yeah, I appreciate that, Kessar. It was a good update. And is there any common questions that we haven't covered that you often field from landlords that are coming to you asking about mortgage products, either new products or renewals?
Yeah, I think just maybe some common misconceptions about buy-to-let mortgages, and the main ones being is like, age. It's not really a limiting factor. With residential mortgages, you've got to pay the mortgage off by the time you retire. But buy-to-let mortgages are different in the sense that, we talked earlier about stress tests. So the lender will lend based on the strength of the property, and then also what rent it will achieve. So, the age on retirement isn't an issue. We've got lenders that will lend a maximum age of even over 100, so you don't need to worry about that. Ultimately, if anything happened to you, they can sell the property and then be able to pay that mortgage off, especially because you're putting in typically a sort of 25% deposit. Income as well. There's a lot of people out there on lower incomes but still have money to invest. They may be retired, semi-retired, or self-employed with low income, that sort of thing. Again, often people think that you need to have a minimum income of 25,000, but that's not the case for buy-to-let mortgages. There's many lenders that don't need you to have an income, or just need you to have a minimum income enough to cover your outgoings. I would say that's probably the main two misconceptions for buy-to-let mortgages.
It's true.
Okay, yeah, no, it's good. Thanks again for your time, Kess. It's been really good to get that update. I'm sure it'll be good to speak again, maybe in 6 months' time, to see how things have moved on into next year and the changes that have taken place with the mortgage market.
Very much so. Thank you very much, Kessar. See you again soon.
All right, guys, thank you.